So far we've talked about a lot of aspects of fintech, and a lot of them were sort of related to finance. But as Steve mentioned in the beginning, a large part of fintech is actually the tech part. And therefore, the title of our next session is actually, what is the tech in fintech? So first, Professor Laughlin will talk about how microwave technologies are affecting the speed of information transmission and also high-frequency trading. And then Maggie will moderate a panel on technological developments in fintech. So Gregory Laughlin is a professor of astronomy, exoplanets, solar and stellar astrophysics, which is a really cool title, at Yale University. His areas of specialization include hydrodynamical and climate modeling of the surface flows on known extrasolar planets. He also has a long-standing research interest in ecophysics and technological infrastructure that underpins electronic markets. He's a co-founder of FLC Networks, a wireless communication design consultancy. And then our moderator for the panel will be Margaret Parent. Margaret Parent is the Executive Vice President of Technology, Innovation, and Operations at Voya Financial. Before then, she served as a managing director and head of GTO Corporate Technology for Americas of Deutsche Bank. There she was responsible for delivery of all finance, treasury, risk, legal, and compliance systems and services for the Americas region. Prior to her role at Deutsche Bank, she served as a managing director at Credit Suisse and a managing director at Morgan Stanley. So we'll start out with Gregory Laughlin. Thank you for being here.
So this is a tough time to give a talk because it's kind of right in the middle of the kind of afternoon sleepy time. So my job is to make things interesting and keep everybody awake before our panel starts. And so the title, the talk I was asked to give is, what is the tech in fintech? And that's kind of a huge topic for 20 minutes. And when you kind of think about what's going on right now, the things that immediately come to mind are distributed ledger technology, blockchain, artificial intelligence, the actual infrastructure, communications infrastructure, and computational infrastructure that all go into this huge thing, and then as well as big data. And so obviously I can't talk about all of those things, and so I wanted to focus on the intersection of big data with the way that the modern markets are working and the way that intercommunication occurs in the modern markets. So I've got this thing. Let's see if I can go forward in the slides here. It's tech, and the fintech is. Oh, there we go. Let's see if I go back. OK, so let's try that again, get my technology right. So it's an old story. Right, so the kind of the interface of technological developments and the financial markets have been going on for hundreds of years. One of my favorite examples, and ones that's quite relevant to the talk I'm talking about now, is at the end of the Civil War, it was still possible to short Confederate bonds on the London exchanges. And so when the Confederacy surrendered to the Union, there was a period when London didn't know about that. At that time, there was no transatlantic cable. The transatlantic cable that they built in 1857 had broken right after it was put in. And so this gentleman, Diamond Jim Fisk, invested a lot of money to build a telegraph line to connect New York to Halifax, Nova Scotia. He knew that the South was going to likely lose on a short time scale. And so he literally had a steamship coaled up, fired up, ready to go. As soon as that telegraph signal reached the steamship, he headed across, sent his agent across the Atlantic, and made a lot of money by shorting bonds for 2 days before anyone else found out about it. This story has just repeated itself again and again over history. And so what this is a kind of a big data scrape of the Federal Communications Commission microwave database. This is all of the different links that have been licensed during the period from, in this case, 2011 to 2015. And what you see is kind of a lot of activity nationwide. It kind of goes with the population. But the one really interesting feature in this map is this triangle. It connects Washington, D.C. with Chicago and New Jersey, New York. And so if you're just sort of showing up and sifting through the database, the immediate question is what's going on here? And so with Google Earth, you can zoom down into the kind of the locus where everything is coming in Chicago, and you might expect to see the Sears Tower or the Loop or something like that. But when you zoom in, this is where all the licenses are landing. And so the immediate first thing that you might think is, oh, it has something to do with those two strange circles. That's Fermilab, and that's where many elementary particles that we now know about have been discovered. That's kind of like the culmination of US sort of technological leadership that was started with the Manhattan Project. And interestingly enough, Fermilab's largest machine, that large ring there, shut down literally as those licenses were being granted. It no longer is running. And where the licenses are all going in is to this building right here. And if you kind of zoom in more and more, you come in on top of this building. It's completely featureless from the top. But the one thing that you do see is lots of power going into it on the right-hand side there. There's lots of high-tension wires going in. And if you get into Google Earth, you can literally drive down Deal Road. Oh, I thought I was being arrested there. You can literally drive down Deal Road in Google Earth, and you can look for any sign of what's going on there, and there is no sign. There's no sign on the wall. There's no indication of what's going on, other than the fact that the landscaping is quite nice for a warehouse. And there's armed guards and lots of security. So something is going on in here. And what's going on is this is where the global equities prices are being hashed out and determined. The trading floors have been completely replaced by financial technology, by field programmable gate arrays, by racks of servers, and it's all happening inside this data center. It's now owned by CyrusOne, but which was built by the Chicago Mercantile Exchange. There's a fantastic story about how the Merc basically got its start in the 1850s and why Chicago is the epicenter for the securities market in the United States, why the price formation is occurring in Chicago. And so this is very much tied in to this topic of high-frequency trading. High-frequency trading, of course, was massively in the news in 2014. What I've done here is I've just looked at the frequency of how often people have searched on Google for high-frequency trading. And what you see in this graph is that up till roughly a little bit after the financial crisis, high-frequency trading was not very much on the radar. And indeed, it was during the time that it was not very much on the radar was when the enormous profits were made in high-frequency trading. In 2009, of order $25 billion was made by high-frequency traders. Now the profits are much less, but public interest is much larger than it used to be. And of course, that was precipitated in part by the huge popularity of Flash Boys. And so there's a lot of interest in how has financial technology kind of reshaped the markets? How does all this stuff work? It's something I've been very interested in the past few years and have been looking at. And so I wanted to share some of the nuggets of how big data, how financial technology are coming together to shape the markets that we have now. So this building is this picture I actually took. This is in the Loop, or close south of the Loop in downtown Chicago. It looks like a fortress. It used to be a Montgomery Ward distribution center. And it's entirely filled with racks of computers now. So this is the 350 Cermak data center. And in 2010, this was where the Chicago Mercantile Exchange was located, at least for the electronic part of the trading. At that time, there was still trading floor. There was still pit traders. That's all gone now. But in 2010, this is where the sort of like the financial markets were starting to really come together in an electronic way. There's other exchanges in there. ICE is in there. And it's also what's called a carrier hotel. And so it's a nexus for all of the sort of fiber plant that crisscrosses the United States. And it's a place where you can get very rapid telecommunications between all sorts of different financial centers. And so in 2010, we pretty much had our kind of modern market infrastructure in place, but things are slower. Kind of my way of thinking about how the financial markets work is that you have trading in securities in New Jersey. For instance, in Mahwah and Carteret and Secaucus are where the data centers of NASDAQ, the NYSE, and BATS Direct Edge are located, as well as all the currency exchanges, many of the bond exchanges, a lot of financial exchanges are in those three spots in New Jersey. And then in Chicago, you have those two buildings that I'm showing in the previous plots. You've got 350 Cermak, which currently has ICE, and you have the CME in Aurora. And then you have sort of trading go back and forth, and you also have exogenous events occurring in terms of news. The kinds of news that is large enough to make a macroscopic, macroeconomic impact is coming out of data centers and press lockups in Washington, D.C. And so the kind of the way that the market is working right now is that you have a constant back and forth between Chicago and New Jersey, which equilibrates prices between the futures exchanges and the equity exchanges. And then you have a constant set of shocks, which are coming in terms of news events, which are announced and then which are priced into the market as quickly as possible. And so there's this kind of triangle of information exchange that dictates how things work right now. And it's really true that as far as the modern markets are concerned, the S&P 500 E-mini future is where it's at. So this is the most liquid, high-volume security in the world by a large margin. It trades over several million contracts a day, and something like a notional value of $100 billion or more is traded every day on this S&P 500 futures, which trades in Aurora. And what's interesting about the S&P 500 futures, this E-mini contract, is that even though it's the most liquid, even though it has the highest dollar notional volume, it has an intrinsically large spread. So the smallest spread on an E-mini contract is $12.50 for a contract which is now trading of order $125,000. That intrinsic spread, the minimum increment between pricings, is 2.5 times larger than the equivalent spread on the equivalent contract that trades for the actual equities in New Jersey, right? So the most liquid equities contract is the SPY ETF, and that is tied directly to the E-mini, but because the spread is 2.5 times larger on the E-mini, as the E-mini trades up and down, the S&P ETF, SPY has to follow, and so you have this constant kind of race to equilibrate prices. And in fact, the E-mini determines not just what happens on the SPY, but it determines what happens on all of the stocks that trade in New Jersey. So this is kind of a big data plot that I made using data from still quite a while ago, back in 2010. So this shows on July 23rd, 2010, this is showing what happens to a whole universe of stocks trading in New Jersey whenever there's a traded uptick or downtick on the E-mini. And so what you see is that at that time, if there was an uptick or downtick on the E-mini, a millisecond later, 5 milliseconds later, literally nothing had happened in New Jersey. And then all of a sudden, there's all sorts of activity, which occurs every time there's a trade up or down in Chicago. And what that's telling us is that at that time, the communications infrastructure that allowed information to be equilibrated between the markets, it took 8 milliseconds for that to occur. The speed of light travel time between Chicago and New Jersey is right around 4 milliseconds. So it was taking at that time twice as long as the speed of light for things to equilibrate. And so at that time, if you could come up with a faster way of doing things, it would be worth literally hundreds of millions of dollars per year, perhaps billions of dollars per year. And so people tried to do that. And there was this kind of great story in the fall of 2010. a few months after the plot that I just showed, it was announced that this firm, Spread Networks, had spent $300 million to build a fiber optic cable between Chicago and New York, which would connect the markets 2 milliseconds faster than had previously been possible. They did this both by eliminating as much latency as possible from their equipment, but also by building a straighter path. So in particular, in Pennsylvania, previously the fiber had traveled along old railroads rights of way, which went further north. They took the care to actually drill through mountains to get a shorter path and to shave 2 milliseconds off the one-way light travel time between Chicago and New York. Unfortunately, they forgot a basic principle of physics when they did this. They forgot that the speed of light is 40% slower in glass than it is in fiber. There was an article in Forbes right when this fiber optic line went online, and so I'm sure that dozens of people read that article and were confused, because why would you build a $300 million fintech infrastructure if it could be immediately obsoleted? I'm not going to go into detail in this plot, but the upshot here is that if you want to get lots of information quickly from one place to another, the way to do it is to use microwaves. If you try to use ordinary light signaling, light is atmosphere is transparent to light, but if it's raining, if you're going over very long hops, light will get attenuated, and you have to have a large number of hops to get from one place to the next, and it's difficult to get absolutely the lowest latency possible. It turns out that microwave communication, which is effectively long wavelength light, is much more effective at taking long hops and going from one place to another. You can get very close to the speed of light in vacuum by communicating information using microwaves. And so what you see, indeed, if you go on Google Earth and go just outside that data center, you see all of these towers where the microwave dishes are receiving information from relays that run from Washington, D.C. to Chicago to New Jersey along this triangle. This is one vertex of the triangle. There's a number of these towers, all which are parts of independently relays that have been set up. You can do the kind of costing for what it's taken to develop this infrastructure, and it's in the hundreds of millions of dollars. Again, the sort of a big data scrape, you can go through the FCC database, and you can find all the locations that are associated with this transmission technology. And it's a large effort. And so there's kind of an interesting, just looking at this plot right here, oftentimes high-frequency trading is kind of made out as bad guys who are front-running and doing all this stuff. But in this case, the high-frequency traders, in building out these networks, what they've really done is they've effectively put soak lines across Middle America. Each one of these towers costs of order $50,000 to put up and maintain. That's money that goes into local communities, tower climbers, small radio manufacturers, microwave outfitters. It's kind of an interesting way in which the kind of spending on financial technology doesn't just stay in New Jersey, in Chicago, but in this mode is really being distributed across the country. There's now, for instance, networks that are being built to Seattle that will bring the Asian information to Chicago faster. And so this whole thing has become a big growth space. And you can see this in the data. So after Spread Networks built their fiber, and then after all of these microwave networks immediately popped up, the speed of light is now the limiting factor for information transport between the market data centers. So whereas previously there had been no response at this blue line, which marks the speed of light, several years later, you see the entire infrastructure has disrupted and has brought things sort of faster and closer together in that sense. I'm going to skip. Well, this slide is interesting, and so this shows in kind of a microcosm what's going on in New Jersey. So this is a very recent plot where I've looked at all of the various data centers and exchanges that are associated with kind of like the current market ecosystem, and have plotted all of the microwave and millimeter wave links that run between those exchanges. And so you can see there's a huge amount of activity, both on the metropolitan scale to connect individual data centers, as well as on the national scale, and indeed on the global scale to connect the various markets all over the world. I'll skip this plot. What this was a sort of a fly-through of the various infrastructure between the data centers, but I'm running on time, so I'll skip that. But I'll end with kind of an interesting way in which physics can inform financial technology. So in this plot, what I've done is I've focused back on the E-mini. And I'm looking at trading that occurs very close to 10 a.m. in the morning. The reason why I'm interested in 10 a.m. is because there's often economic announcements that occur right at 10 a.m. Those economic announcements are created in Washington, D.C., and then they have to propagate to either New Jersey or Chicago, where it causes trading. And so you can see that over many days, the trading kind of lights up in the milliseconds after 10 a.m. and is very quiescent in the milliseconds before 10 a.m. You can look at this in a different way by simply plotting the number of trades that occur in each millisecond surrounding 10 a.m. And what you can do is you can look and see how the profitability of those trades depends on when they're done. And it's kind of a sobering realization. This shows the profitability of contracts that are traded in the milliseconds near 10 a.m. And the highest profitability occurs in this kind of locus between 10 a.m. exactly and the time when the information can physically reach through the speed of light Chicago. And what you see is that the most profitable trades are done before the information can possibly reach Chicago. This is an interesting thing. Is it illegal? No, it's not illegal, because there's nothing in American securities law that mentions Einstein's theory of relativity. The idea of simultaneity between events is completely alien to the US legal code, and so it's possible to completely legally trade after 10 a.m., even though you're effectively, through the laws of physics, impossible to know what the answer should be at that time. So this shows how financial kind of technology is interfacing with trading, and then how the laws of physics can be used to sort of parse out what's going on. I'm hoping that you've stayed awake for the talk, and definitely am looking forward to the panel discussion that will focus on a much broader range of the kind of financial technology landscape that we're facing today.
Talk about the gap afterwards. That was very interesting.
Wow. So I like many of my colleagues, spend time going out to Silicon Valley and seeing what's new. And on such a trip a few years ago, I had the opportunity to spend a lot of time in various labs and think tanks and consortiums, places like Xerox PARC, AT&T Foundry, and other types of collaborative lab environments like that. And I took the opportunity to ask a really basic question that I had just not thought to ask before, which is, how do you define innovation and how do you think about it? And it was quite, to me, it's a fairly obvious answer now, but I was surprised at the answer. What all of them said, and they said it independently, is don't mistake innovation for invention. Invention is something completely new that departs from the past. And innovation is when you take a known technology, in the tech sector at least, a known technology and apply it to a known business problem. So both ends of that equation are actually established. They may only be recently established, it may be quite new, but it's not invention. You're taking something that exists, You're applying it to a known problem. And in doing so, you're doing that in a way that hasn't been done before, that's innovative, that changes the value proposition of solving that problem and creates value, efficiency, and then ultimately profit for the parties in that type of transaction. So I think that definition of innovation for me opens up your mind a little bit, because it makes you realize you don't actually have to be a rocket scientist or a planetary physicist to invent a new technology. We can harvest what's around us and think about applying it to the interesting business problems that we have. And for me, I'll introduce the rest of the panelists. Part of what is so compelling about this panel, besides the fact that we're going to talk about technology, is that this panel has on it people who have been taking these threads, business problems and technology, and applying them in real live commercial situations for years and in some cases decades, and can speak to the specifics of what they think is going to work and not work with some of the technologies that we've been hearing about today. So with that, to my left is Julien Courbe. He is the head of financial services practices at PwC, which means that he has a bird's eye seat into large companies and advises them on how to transform their businesses, most frequently by leveraging technology. And to his left is Paul Walker, who was a co-head of technology at Goldman Sachs for many years, retired a couple of years ago, and now dedicates himself full-time to exploring dimensions of fintech, including both advising fintech companies as well as investors who are looking at fintech. And then we've already heard from Greg, Yale's own. And so without further ado, we'll jump in and start the conversation. It would be somehow out of keeping if we didn't talk about blockchain, so I thought we would start there, and we have some other things to talk about as well. But I thought we would start there, and we heard a lot today that was really quite interesting. We heard from Blythe Masters earlier, who clearly is a buyer of blockchain, right? And some of us are concerned about, well, how are you going to regulate it? And Blythe is optimistic about that. We heard her say that she's selling it to established market infrastructure. She's selling it to stock exchanges and clearinghouses, and they are in fact regulated, so we're covered. So she's got a very optimistic view of rolling that technology out at pace and leveraging it for the markets. And I'm curious to see if any members of our panel have some differing views on the use of blockchain. Now, I'll ask the panelists, you're welcome to discuss cryptocurrency. There's the intriguing event of Jamie Dimon declaring Bitcoin a fraud just a couple weeks ago. So you're welcome to talk about that, but also bringing it into how financial institutions are thinking about it and might leverage it. So with that, Paul, I want to start with you.
Yeah, and so, I wasn't here for Blythe's talk, but I think she has a sensible approach, and that differentiates her from some of the other individuals in the market as well. And the way I've been helping people think about blockchain and cap markets, and a rubric I give individuals, is when you're evaluating a business plan for blockchain and capital markets, replace the word blockchain with always correct shared database and see if you're still excited, and see what that means for that business plan. I'm going to change mortgage servicing with an always correct shared database. The first question you would ask if you saw that plan is, well, aren't there thousands of mortgage servicers? How are you going to meet them? How are you going to get them to use your database? And all of a sudden you start realizing that business process ends up becoming incredibly important. And the technology is a powerful enabler of that in some cases. But if you ignore that business process and think it's magic because it's blockchain, you're going to make a pretty big category error. And it's one I see, I've seen it in the retail space, I've seen it in the cap market space. And it comes back to my core thesis about financial technology, which is financial technology. We call it fintech now, so it's something new, but that's ridiculous. We've had financial technology for hundreds and hundreds and hundreds of years, right? I'm sure the best high-frequency abacus user was, in finance. And so what we want to remember is there's processes we undertake in finance, the provisioning of capital, the clearing of securities, the management of risk, the management of liquidity. And how does our technology make those better for the consumer, less risky for the operator, or allow you an advantage where you can make a bucket of money, right? But that gets you back to this idea that the technologies are the enablers of this process. So with blockchain, in capital markets, blockchain is a fantastic technology. The fundamental idea that led to blockchain is a real breakthrough in computer science and mathematics. The idea that we actually have a technology where we have a chance of a cryptographically assured transaction being shared amongst all parties without a central infrastructure that allows us to run a ledger that's correct, like that solves a bunch of problems we have in business units, but it doesn't replace those business units. And so what's the software play, and who are the provisioners of that software who will intelligently integrate themselves with the transformation of those business processes as opposed to trying to replace it? The last thing I'll say on this is you can think about, if you go and take a look at anyone who's doing anything in financial markets, you can take a look at how much capital they're allocating to that. So if you think about something like, equity clearing or, a customer business at a bank, you'll just find a couple of $100 million of operational risk capital, a couple of $1 billion of operational risk capital sitting around, right? Or, a few $1 billion here and there for liquidity management as a buffer. Right? These things pop up at banks the size of JP Morgan and Goldman Sachs and Morgan Stanley and all these other companies, and it's all publicly disclosed. This isn't surprising. But if you think about doing that outside the context of the bank with some of those constraints, which exist for a reason, right? If you actually think about liquidity managing an equity clearer, you realize that you actually have a difficult business process to undertake, and blockchain is part of that. But blockchain's not magic. It's just a piece of technology that lets us agree on a transaction. I think we lose sight of that when we get super excited about fintech, or when we see people cranking up valuations in the fintech space as well, and worry we may be missing the boat.
So Paul, one more iteration. One of the things that is apparent is that there are a tremendous number of investment and pilot projects going on across Wall Street.
Yeah.
There's quite a lot of froth. We're all pouring money and trying to see what can we use this for.
Yes.
And so there's an interplay between the investment and then thinking, well, how long is it going to be before we have something that's actually high value and usable?
Yeah.
And I think there's maybe a bid-ask spread. I think if you ask Blythe, because we did earlier today, it's emerging now.
Yeah.
And I think for some of the larger banks and institutions, it probably looks a bit further away. So what's your view on that?
Right, so in 2013, I was asked this question as well by someone who was sure the answer was 2014, and I should have bet against the individual, and I didn't, and I wished I had, because they had deep pockets. But we are starting to see things now with blockchain stand up, right? Blythe has some things standing up, other players have some things standing up, some of the big companies are starting to do things where they intercommunicate. And the patterns that you're seeing all over the place are, this is a useful technology once you do that business process work to figure out how we're going to, make the business more efficient by not having errors, right? You could take a look at any derivatives business where there's still, a com firm you have to sign, or you have to describe a contract in 5 different ways. If you get all of those dealers to agree on a standard, and that standard is implemented on a technology where the information is shared, you will actually save money. We're seeing that now, I've seen that now in several markets, and I think those are exciting. I think they're exciting, and I think they're compelling, and I think they end up with the blockchain providers feeling like providers of very important pieces of software. Much like when we brought relational databases into the world, right? There was, I'm sure there was some, conference somewhere where people talked about the relational database revolution, and they were right. Relational databases are amazing. They changed everything. They made everything great. You'd be dead without them. But, I'm sure there was a conference about the telephone revolution. Telephones are great. We really need them, right? Watch a trader at a turret. And so, I think of blockchain as more like that, incredibly valuable, incredibly important enabler of that business process. And that, to some people, that sounds less exciting, and I think those people are missing the point about what you can do with fintech. To the people who say, geez, we finally can fix that problem with negative affirmation and equity swaps, if we actually all agree. And if that sounds boring to you, then maybe you shouldn't be in fintech. And if that sounds exciting to you, then welcome to ops with me and
I think maybe that's why we see so many pilots and proof of concepts happening on Wall Street, where there's a lot of promise in the future of transformation from blockchain. But to your point, Paul, I think there's some barriers of entry, whether it's about bringing all your counterparties to play with you, establishing trust in the system that you're kind of putting together, and then potentially some regulatory pressure. At the same time, I think if we think a little bit longer term, right, and without paraphrasing Bill Gates, I think we're probably underestimating, or we're overestimating what can happen with blockchain in the next 2 years, but we're underestimating the impact it could have in financial services over the next 5 years. And so it's really kind of at what time we're going to see broader adoption that could actually have an impact in the systems.
I agree with that.
And Greg, did you have a thought to add?
Yeah, well, I think I've been very interested in blockchain, but more from a perspective of a physicist, where proof of work is now costing 2 gigawatts, roughly. And because SHA hashes are found about 1.8% of the time, 2 hashes are found relatively simultaneously before the information can kind of propagate over the entire world. And so there's tens of millions of dollars worth of electricity costs being wasted every year as a result of latency on the blockchain. And blockchain, is huge right now, but if it gets much larger, it starts to have a macroscopic, literal impact on the physical world. So, if you're talking about hundreds of gigawatts of electricity being used to do hashing, you're talking about sort of an economic drag, an economic cost that I don't think was factored into the original formulation of the problem.
Yeah, it's integer percents of the world electricity usage.
Yeah.
Goes confirming moving a piece of maybe it's money from one anonymous wallet to another anonymous wallet. That may not be the best design.
And then integer percents of those integer percents are completely wasted because of latency.
Exactly.
So it's interesting. It feels like this panel's a little more, I won't say bearish, but a little more muted in the excitement about blockchain, sort of tempered by unintended consequences, as well as just the reality of implementing it in a business. I know many of us have looked at fintech companies that are trying to build product and companies around blockchain beyond cryptocurrencies, and many of them don't look that viable right now in terms of being useful to business. So because we do have some students here, I'm wondering if, and I heard Julien, maybe back to you for this question, you said, I think we may be overestimating blockchain's impact within 2 years, but underestimating in 5 years and beyond. If we have students here who are considering doubling down and jumping into a fintech startup that's blockchain focused, how would you set their expectations?
Well, I think as we just mentioned, I think you need it is actually a very exciting space. I don't want us to look like we're not excited. I think it's a great technology, it's a great innovation that could actually transform the financial services systems. I think to a large extent, there's a lot of investigation, a lot of research to be done. It's a bit of a long-term bet. But when we think about what can happen whether it's in the mortgage industry, in the secure lending industry, in the even within the bank's environment, in the clearing settlement space, I think there are some opportunities to further optimize the business processes and so on. But it is probably a 3 to 4 year time horizon before we see massive deployment of the technology.
The other thing I'd say, so I left my physics research career to join finance in 1998 when we were just starting to get CDS, right? And we, still had fractional trading on equities, and we didn't have high frequency trading, and no one had worried about CCAR or balance sheet or capital management, and there was no block. So, for a student approaching the first day of their career in fintech, the most important thing they should realize is everything they know will be useless in 5 years, and you'd better like learning, right? I think that's really the lesson, right? So, if you think you're going to build a 40-year career at this blockchain startup that you got a job in out of your undergrad or your graduate program, sorry. You're just wrong. In fact, I was talking to a young person the other day at a different Ivy League university when I attended instead of this one, and he had done some work on blockchain. He said, "I'm really worried that my blockchain career might get disrupted by quantum computing," and I just chuckled. I'm like, "Yeah, okay. Think about your career a bit more expansively, right?" So. If I were talking to a young person who was considering joining a blockchain company, I would ask, is it a good company? Do you think you'll learn something from the leadership? Do they have people who are paying them some revenue? Do they have a project that excites you? And if the answer to that is yes, it's probably not a bad move. And if the answer to that's to no, go find a place where the answer to all those questions is yes. Right?
That sounds like good advice.
Yeah.
Okay, so moving off blockchain and thinking about other kinds of technology, some of which have been mentioned today. Artificial intelligence And the way I think about it, and our panelists may have different views here, is I think about it as a progression, starting with something relatively mechanical, which people talk about robotic process automation. And there are a lot of software tools there. And actually, almost every technology person I talk to about this, and there have been many in the last 6 months, say, yeah, that's like a modern version of screen scraping. Because what people are often doing is they're taking very old applications, some of them are COBOL applications, and they're hard coding, typing into the prompts as a human would, and just doing it really fast. And so suddenly now you have an environment that's a lot more automated, but you haven't necessarily advanced the technology case. So you have robotic process automation, you have machine learning, and then if it's a building pyramid into the concept of AI, which is real artificial intelligence. And so, Julien, I know you spend a lot of time advising companies on how to adopt and leverage these types of technologies. And what are your thoughts about the business solutioning value of these products?
Yeah, I mean, I think it's another solution, another technology that could create tremendous opportunities and benefits for financial services institutions. If we think about artificial intelligence, I think you're making a great point, right? The evolution of robotics, adding machine learning or deep learning on top of it. If you think about artificial intelligence as the way to automate tasks that are traditionally done by human intervention that require complex analysis and things like language processing and facial recognition and what have you, the ultimate goal of AI is to actually have a software that can acquire common sense. And to some extent, a lot of the research is actually being invested into these deep learning or machine learning capabilities to acquire that common sense. And there's a lot of applications in financial services, in trade execution and exception handling. There's opportunities in the investment decisions. We've seen with the rise of the robo-advisors, a lot of activities in how AI and machine learning can actually optimize the investment decision that you make. We've also seen AI being applied in the fraud or in the market surveillance space. And fundamentally, as I mentioned about helping the software acquire common sense, there's a very iterative process being fed by a lot of data to actually learn how to optimize that process that you're looking at. So a lot of companies are investing in the preliminary AI solutions that eventually over time are becoming more and more intelligent and transformative of the process that you're handling. Another big opportunity is in the market surveillance space. And so FINRA has deployed a large artificial intelligence solution to look at 50 billion trades a day and to learn from these trades what could be actually become issues or alerts that they need to investigate from a market oversight perspective. So a lot of things are changing. I think we're still in the early phases of AI for sure. And as the machines are learning more and more, we'll see actually the development happening and the business being transformed by AI over time.
So I want to push you just a little bit on this to go back to my opening comment about innovation, unlocking value. Do you think in financial services, you gave examples of trading, and we've been doing program trading for a long time, but you go further into investment decision making. Do you think today we are or have deployed these technologies in a value-adding way in the financial markets?
Well, I think if we think about investment decisions specifically, and if we think one example being robo-advisors, the value add was the lower cost of processing, right? So you create suddenly a solution that makes the investment decision at a fraction of the cost. So that creates a value for the customers from that perspective. As one example.
So you're bullish on this technology?
I'm very bullish in the long term. I really think that AI is going to transform the industry in a large extent. I think it's going to transform a lot of the industry in front of us and a lot of what we do today. I think the governments are investing also massive amount of money in the AI space to lead the way on discovering kind of the next phases of artificial intelligence. But I'm very bullish on the opportunities that exist in the long term.
Okay.
Look, So I think the mathematical and computational advances we've had in the AI space in the last 10 years are some of like the coolest stuff there is, like the image recognition problem getting cracked and deep learning. And, I've invested a lot of my time actually digging into and understanding and, reading and coding and everything else, and it's really neat. And but it led me to a couple of sort of practical conclusions in my business life, as opposed to my math and computer nerd life, where it's the coolest thing ever, and you can just download TensorFlow and everything works and it's great. And those two conclusions, first of all, one of the things we all learn is correlation is not causation, right? But AI is based on the idea that yes, it is, right? That you train a big data set and you find some correlation between the inputs and the outputs that you don't understand, and then you run that on the new stuff and assume you'll get the same thing. Or more accurately, it doesn't care about causation; it's just detecting correlations. And so I think it's important, if you're going to be thinking about the application of AI, that you actually do bother to understand some of the technical information about how you train, what the prerequisites are. I think there's two other things I want to mention. The second is that the prerequisite of AI working, because remember, it started working in the image space and it started working in the collaborative filtering spaces. Those were the two spaces where we had commercial deployment of AI that actually mattered in the last decade, was that there was a business process which had as a backdraft of that business process a collection of data, right? The Netflix recommendation engine wouldn't work if Netflix didn't log all the movies you watched. The Amazon shopping recommendations engine wouldn't work if Amazon didn't know everything you put in your shopping basket. And so one thing to think about as a practitioner in finance, if you're thinking about deploying AI, is which of my business processes have that data backdraft so I can apply these correlation-based techniques? And also, which of my business processes do I want to change to improve my data backdraft so I could apply them as well, right? In capital markets, the amount of data that is dropped on the floor because the salesperson says it in a phone and doesn't type it in anywhere is enormous, right? And that's what takes a lot of those it's one of the things that takes a lot of those Amazon-type application of AI to customer need out of finance. And so for those of us who are practitioners, we need to think about that data collection. And the last thing I'll say, and I see the next talk we have coming up is deep learning for finance, so maybe the gentleman who's giving that talk will disagree with me, but it seems we don't have a very good understanding of why these mechanisms work on a technical level, right? It's sort of like we had neural networks and they didn't work, so we stuck in a nonlinear function in another neural network and then it started working, and that's kind of good enough, right? That's a gross oversimplification of the entire field, but I think there's a lot of progress to be made in fundamental analytics around AI that will reflect themselves very, very rapidly in our ability to solve problems. And I don't think we have it today in many places. So the way I think about it is pay close attention to the technology, think about where correlations are useful, and think about your business process data backdraft so you're ready as the improvements keep coming.
Yeah, well, I think machine learning, artificial intelligence can scale up assessments, and for things like fraud detection, it's incredible. But it's also important to remember that the world is fundamentally nonlinear, and because of that, the whole world is subject to very strong dependence on tiny changes in initial conditions. And so I think artificial intelligence can't change that. There's always going to be a whole diverse possible range of outcomes, and I think that I'm much more sanguine with kind of betting on the human mind for assessing what can happen. And I think that that's really where our advantage lies and will continue to lie for the foreseeable future.
I also think, by the way, I agree with that 100%. And also, it points out that our artificial intelligence engines are as good as the training sets we give them. And so if those training sets are limited to standard outcomes, if you trained an artificial intelligence engine on 2015 to today and then asked it to predict 2008, it would have no idea, right? Mm-hmm. And so that's why I think, if you're going to engage in this in finance, you actually need to understand quite a lot about how it was actually used. It's not a black box yet.
And I think there's an element where the way we're talking about it, there's kind of a Venn diagram overlap space between predictive modeling and AI, because they're kind of correlated, not necessarily exactly the same thing, but they're correlated. Not something I've experienced firsthand, but anecdotally I've heard from colleagues who've gone down this path. Speaking about unintended consequences, imagine you're in a situation where you're building an engine to automate small loan approvals, right?
Yes.
And you discover that there's a zip code that has a relatively higher default rate on repayment. And so you blacklist the zip code and you say, we're not going to give loans to that zip code because their default rates are above the norm. And then you kind of look at it and realize, well, that zip code may have a different ethnic makeup or a different demographic in terms of household income. And what you've done is you've just built in a bias, potentially even a racial bias, to an automation engine. And so I have heard anecdotally of those who are really trying to use this, that comes up frequently as they're working through it.
You have to be super careful. Your nonlinear function that you learn is a reflection of your input set and the question you ask at the output. So if your question you ask at the output is, what's my default rate as a function of zip code, and the answer to that turns out to be something that's not regulatory compliant, and you haven't put regulatory compliance into your training model somehow, you can get an answer that would get you in trouble. You know, it's like there was this piece of research, and I will admit I didn't read the full paper about these programmers who had trained a facial recognition detection engine to see if someone was a gay individual or not, right? And one of the most accurate criticisms of that is they've got an AI engine that does, you know, recognition on their input biases to their output biases, right? And so you have to be super careful on this stuff. It's a very, very delicate field.
And I think the other part of it is in the AI development, a lot of the concerns are it's hard to find a reason for a decision, right? There's a lot of data, there's a lot of analysis being done. And so your example of credit, and a lot of credit agencies are looking at AI to help them make credit decisions. They're not really equipped today to be able to tell their customers the reason for a deny or an accept decision. And so there's a lot of additional work that needs to be done to actually be able to get to that type of answers.
Right. We may be getting at, you heard in some of the earlier panels the idea that large financial institutions move slowly in the adoption of fintech. I don't necessarily agree with that, but you may be hearing some of the back explanations that it may not be as simple as it looks, right? Which is part of what we have to deal with in the real world. Shifting again, I think something we spoke about as a group as we were preparing for this panel is that when we're looking at that innovation space of business problem with a technology capability and adding them together to create value, there's often a tendency to look for the newest, most interesting technology, some of which are still finding their feet, like blockchain would be an example, or something highly technical, like graduating to a microwave-based technology because you're trying to get as close as you can to the speed of light. These are sort of highly technical solutions. And one of the things that we wanted to bring back into the space is that sometimes it's not a sophisticated problem nor a highly technical solution. There's a lot happening in the fintech space right now that are simpler problems with simpler solutions, but they're unmet needs. And I'm going to share an example, and I'm going to ask my colleagues here to chime in also with a couple of theirs, and then we're going to go to questions. So my example is the firm I work at now, Voya, has a business in helping people with financial planning, particularly a focus on retirement. We manage 401k plans for large corporations and small and medium. And one of the things that I've learned, I've only been there a year, about the whole retirement and financial saving profile of the United States in particular, is we're not saving nearly enough for retirement. And when you look at it, it's actually very hard. There are tens of millions of Americans out there who have a very hard time making the decisions. It's about paycheck allocation. It's about the millennials, who we've also been talking about. They're turning 38 this year. They are the largest population having children and taking out mortgages. They have a lot of financial pressures. They also are carrying a higher level of student loans than any group in the history of the country. And so they've got a paycheck. They've got to figure out their base expenses. They're saving for their mortgage. They've got their student loan. Now they've got a health savings account. They've got to put a little money in there. And then there's a 401k, and maybe they just had a kid. They need a life insurance policy. And they're just trying to figure out, how do I make those decisions? And coming up with something as easy and simple as tools and portals for that buffer them from a lot of the individual decision making, allow them to model leveraging behavioral finance techniques. Those types of tools right now are extremely needed and very helpful. And it happens to actually be an emerging and very crowded fintech space. So they're not using blockchain to do this. They're designing websites. They are, in fact, employing some interesting behavioral finance and some math, some Monte Carlo projections and things like that. But it's not the kind of super high tech that people think of sometimes when they think about fintech. And so with that as backdrop, my colleagues actually spend a lot of time out looking at fintech companies and thinking about, are these interesting solutions for the problems we have in the real world? And so I wanted to just take a quick pass and say, what's interesting that you've seen, and how do you think about, beyond blockchain and AI and all the buzz that we're talking about, what else is out there that's important?
Go ahead.
Yeah, so I think first of all, I want to just spend 10 seconds reminding everyone that UX matters a lot, right? The company that actually figures out how to help you save is going to be the one with the nicest looking, easiest to use, most comprehensive calculator. And so UX is an incredibly important part, especially the consumer fintech experience. But what I really wanted to say and answer this question is, there's sort of a, no true Scotsman question about fintech, right? What is fintech? This is fintech and this is not fintech when both people are writing software that deals with derivatives, right? It's hard to tell. And a story that Goldman Sachs is actually on the record with, and I checked before that they were on the record. I told a story at lunch, and I found out that they were public with it. In 1999, they had 600 equity voice traders. In 2015, they had 2, right? And so, I sort of wonder whether the 598 people think that there wasn't a fintech revolution in equity trading in that period, right? And so one of the things to remember is that technology has always changed financial services. And so I think we do ourselves a disservice when we ignore the technology that actually runs the financial system, right? Remember, none of the technology we've talked about today actually makes your check clear so when you do your job, you get paid, right? That's all COBOL and FTP, right? DTCC, where both Gary Stern and I served on the board, and Steve as well, processes 3 times the message volume of Twitter every day on a mainframe that always works, right? And so I guess my appeal to what's cool and new is to say, hold on, maybe that's not the right question. Maybe the right question is, what's actually running the financial system and how can we make that better? And where is there money sitting around in that? There's a lot of money sitting around in the US financial system to be made and reallocated and moved between participants. And so thinking that you're only going to do that with blockchain, when maybe you'll just do it with, a leased mainframe and some COBOL you bought from someone. COBOL works, right? It's Turing complete. It may not be the end of the world, right? And so I sort of wanted to end my comments with that appeal to maybe, instead of thinking legacy and future, we should think production and not production.
Yeah, maybe if I can add, and I'll add maybe to what you, Paul, how you started. I think there's some very simple concepts that the fintech world is trying to address as well that, as you said, actually, Maggie, create a significant opportunity for investments and so on, innovation. And that's something as simple as financial planning, right? How much should you save? How much should you spend? How much should cost your cup of coffee if you want to put money aside for a big purchase or what have you? And many companies are really trying to capture the opportunity to provide financial planning in an automated way. And it's really not about the technology that's under financial planning, because it's a very simple technology, but it's more about, to Paul's point, the experience. And so it's really, a lot of the fintech firms are turning to the experience of consumers as they look at things like as simple as financial plannings, where they don't want to go to a branch to talk to a financial advisor necessarily. They really want to have on their phones some advice on, again, how much they should save when they're planning for, how much they should spend for a trip they want to make. And again, the winners of this space are going to be the companies who develop the most intuitive user experience, as Paul mentioned. And a lot of the retail banks today are really trying to, all of them have an initiative called Financial Wealth, or a name like this, that is really trying to capture customer engagement on their digital channel and make sure that customers are engaged and that there's kind of coming back to their applications on a regular basis to really get this type of engagement and interaction between the banks and the customers.
Okay. a final thought from you, Greg, before we turn to questions?
Yeah, so I think with financial technology, something that always kind of occurs to me is that there's never enough time. If you're a high-frequency trader at the kind of the lowest levels of latency, and there's 55 nanoseconds to make a decision, you're not using artificial intelligence, you're using very simple heuristics and lookup tables. On a much longer time scale, if you want to sort of do proof of work for Bitcoin, by the time you've invested in your Antminer S9 and got it online, there's faster equipment, and so you're thwarted in that respect. And even on the kind of intermediate kind of human time scales, I had a cool video for my talk that was high tech, and I didn't have time to give it. And so it's always the things that are tried and true and that work that you're comfortable with are often the ones that end up being the most lucrative and kind of working the most to your advantage than what's just shiny and new.
Okay, so with that, we have some time left for any questions, comments.
Here we go.
Hi, yes. So we've talked a lot about the technologies kind of in silos, right? The DLT, AI. I was just curious, I think one of the things that kind of makes this time special in history, kind of the fourth industrial revolution in general, is the aggregate complement of these technologies. And I was wondering if I could just hear your comments on kind of how you see these technologies complement the complementary elements of that, and whether that be to how they change kind of the business models or the revenue streams within financial institutions themselves.
Sure. So I'm going to start with an example from the consumer space that I was thinking of while we were making the earlier comments. So I'm going to set a challenge to the room. You have to have a brand new Weber barbecue at your front door by the end of business Tuesday, and you can't leave the room. Okay, how many people can actually accomplish that? I can, right? Okay, so the reason I bring that example up, right? I hope, by the way, it would be wonderful to see what happens to Amazon's data mining team if we all ordered Weber barbecues from Amazon Prime right now. The reason I bring that up is because here's an example of a convergence of technologies in the consumer space that have effectively become invisible, right? You've got your credit card payment, you've got your mobile phone, you've got your network, you've got your UI, you have the inventory management at Amazon, you have the shipment from UPS, you've got the pre-existing Amazon Prime contract, right? All these things have stopped becoming individual things, right? Because if I'd have asked that question a decade ago, everyone would have been, well, I would have picked up my phone and dialed Sears perhaps and read them my credit card, right? And if I'd have asked that 20 years ago, everyone would have said, what the hell, we can't all get barbecues by Tuesday without leaving this room, right? And so I fundamentally agree with your thesis that technologies become invisible as they become cooperative, right? And the financial system has a lot of that happening in it, right? Most people who work in finance have no idea what actually happens when you buy a stock, right? The technology and business processes become so seamless that it always just works, right, Steve? Exactly. But that doesn't matter because you end up having this opportunity through this confluence of technology. So I think AI and blockchain are interesting. I think AI becomes more interesting when, as Julien was saying, it becomes just the way that you get the answer on what you should do in your personal wealth, right? Where you don't have a banking app which feels foreign, you just have I'll go back to the barbecue example. If I wanted to send you $374 right now, that would actually be hard in the United States, right? Like, do you have Venmo? Do you have PayPal? What's your email address? Do I maybe have $374 in my wallet, right? So clearly there's an opportunity for that same sort of invisible convergence of technology to apply more in finance. I think AI will be a big part of that from a end user perspective and from a wholesale operator perspective. I think blockchain will be incredibly important, invisible part of many processes a decade from now. But another way I would answer your question is, how do technologies become invisible? And everyone we talk about here hasn't yet, and in that sense, it hasn't succeeded yet.
Actually, I would pile on with, in addition to the barbecue, another example, which is Waze. right? People use the map. We've had maps for a long time. We've had position location data, and we've had crowdsourcing of information, and putting those things together into ways. You don't think of the components anymore. You just think, I got to get somewhere, and it's second nature. So to your point, I agree with your point emphatically, and I think there is an acceleration of these convergences coming together, and it's really quite exciting. Let's take another question. I think there was another one over here.
Hi. So in recent years, these big financial institutions have been hiring a lot of technology people, and I'm just curious, for this kind of upcoming like business process optimization or innovation, how much of it do you think will come from within financial organizations, and how much from external consulting companies like Palantir or Accenture, and how much from startups?
I think it's a lot of a combination, right, of resources. I think every bank today is looking to upgrade their talent in terms of technology savviness, as well as, frankly, upscaling improving the skill, or what I would call the digital fitness of their existing employees. And it's true in financial services, it's true outside. And if we think about the CEO of GE announcing a year ago, I think, that every new employee will have to do 6 months of programming as they start their career at GE across their entire organization, whether they start in marketing or finance and so on. So I think there's a combination of getting your existing employees more technology savvy, hiring different type of skill sets, like in the AI space or in the digital space in general, and then relying on fintech and third party to provide you some technology or some advice that continues to help you evolve. So I think it's a lot of combination of all the above.
Yeah, I would actually agree with what Julien said, but even give you a sort of more forceful answer. Every financial institutions have lots and lots of technology people. It's usually the largest division in the firm. Most of the firms you've heard of have tens of thousands of IT people. It ends up being, usually 30-40% of a company. So it's a large population. But I would say nearly every single one of those people understands that they are part of an ecosystem. And that ecosystem is leveraged not by accident, but very consciously. One of the firms I've worked at every year used to fly 50 to 80 senior technologists to spend an entire week in Silicon Valley meeting with venture capitalists and looking in a very structured and formatted way at fintech companies, and looking armed with problems to solve. Like, these are my problems. In fact, that's the way years and years ago that we discovered in my institution microwave network technologies. By going out and talking to people who worked in the gaming industry as part of their attempt to do multiplayer work. So I think, and the consulting firms are tremendous partners because they can bring in the experience of having worked with multiple firms and say, oh, do it this way, don't do that. We've just watched 3 banks fail doing that. So it is an ecosystem. It's one that is very consciously leveraged. Where people work hard at their relationships and making sure they have the access to the information. There are more fintech companies than you can ever work with. Part of what's important is developing relationships that help filter those down to the important ones, and then really having the wherewithal to look at it. And one other thing about this ecosystem is there's money flowing around all the legs of it. So lest you lose focus, there's real money involved. The venture capitalists want to invest in companies that have real value to the financial industry. And so they're watching the interplay between the banks and the startups, saying which are hot, where's the money going to really go? And similarly, the investment that a bank may make, they probably have a private equity arm, so they can follow their IT guys out to Silicon Valley and say, what looks hot to you? And work on developing those relationships to engage and make investments. So I think the ecosystem is critical. It is one of the very fundamental ways in which fintech works, and it is extremely consciously leveraged. And there's money at stake around that. The way the entire thing is constructed. So another question up here.
One of the things that's been going across my mind throughout this whole conference and picking up on your point right here is about the competitive aspect of fintech. We've been talking about very large companies here being able to make large investments and revolutionize themselves. I come from the insurance space, and both on the life and P&C side, there are hundreds of very small and mid-sized companies in very small towns across this nation. So is fintech going to be something that's only the big boys are going to be able to play, and eventually these smaller companies are going to have to merge or be consolidated? Or is the technology going to become affordable enough that the smaller and mid-sized players are going to be able to afford it and effectively compete?
I mean, look, I think people will make money however they can. So if small companies are willing and able to pay for services that you can sell at a positive margin, then they'll become available, right? So that's sort of one class of answer. I think technology is a radically deflationary force, right? We need to remember that, right? One of the things I used to like to do when I talked is, ask people, what does a car cost? And, you'd get a number like 25 grand, and like, what's dinner for two with wine? And you'd get like, $300. And I'm like, well, what does an app cost, right? And it's like if you're over 35, you say 99 cents. If you're under 35, you say 0, right? But then if you imagine that question 2 decades ago or a decade ago, you'd be like, well, right, it's $60 and it came in a shrink-wrapped box from Best Buy, right? So I think for the more numerous and smaller end of the financial market, there's a lot of hope that these technologies become available in a deflationary sense and they become much cheaper. That's sort of the Salesforce story in many ways, right? A world-class CRM system that you can just buy with your credit card, right? The problem with that thesis is if you actually need the financial innovation to win the competition from the person who's been able to deploy it, right? I can deposit a picture with my iPhone app, becomes a killer feature for 6 months, and then something that everyone has, right? And so, the way to think about your question, I don't know the answer to your question, I don't think anyone does know the answer to your question, but the way to think about your question is the offset between the tension between technology will become radically cheaper for me as it always has, and so I'll be able to deploy these things that were unthinkable 2 decades ago, versus, but my competition had it 2 years earlier because they had more spend available to them, and that 2 years was an existential difference in my business. And so.
So I'll chime in and add one thing, because I spent most of my career at a large financial institution, and now I'm at a mid-size in the same sector as you described, and I own innovation for the institution I work at. Leveraging that ecosystem is an essential survival. If you're one of the large institutions, you can see something interesting and then open a $50 million division to build it yourself. You've got the money to sort of make a lot of different choices. When you're in the middle of the marketplace, you have less wherewithal to do that. And leveraging the ecosystem and creating partnerships that generate revenue for multiple parties is the fastest way you can innovate. So I think it's, in fact, a really important asset for the small and mid companies to use.
Yeah, and I would actually add to this, to take that example, I actually feel the fintech world is actually an enabler for the small companies to compete with the big guys, right? So if you think about it, this is a way, if you want to digitize your claims processing system in your insurance company, you can really compete with the larger companies who have presence in 50 states, where you might have presence only in 7 states, by leveraging technology. So for me, that's actually an enabler for scale. And that's really what can make a difference. So I don't really see this as the big companies investing versus small companies investing. I see this really as a way to bridge the gap between the scale that a big firm would have versus compared to a small firm.
Right. Everyone gets the same capabilities,
Exactly.
so you compete on your actual business model.
Exactly.
Is the convergence state of the technological revolution everywhere.
And I think that is a great place. We're out of time, and I think that thought is a great place to stop. I think that's exactly a way to think about how fintech is going to impact the industry.
Great.
So thank you.
All right, thank you.